Section 5, P-TECH course number 4, Appraisal of Personal Property. Basic terminology. Book value of inventory. The acquisition cost to the business to acquire the inventory, which is entered into the books, financial records. Book value of used items. The acquisition cost of the business to acquire the asset, which is entered into the books or financial records, less any IRS allowed depreciation. COGS or COGS, cost of goods sold. Density methods, use of tables or schedules that show typical property value per unit of measure for types of property with certain characteristics, known as the square foot method. The personal inspection method or the comparison method. Domicile, legal residence of the owner or of subject property. Domicile situs requires level of trade of owner with inventory. FIFO, first in, first out inventory accounting system. The inventory items with the oldest historical cost are removed from the company books first. This is a more accurate method of cost accounting as it will more closely reflect the cost of inventory as of the date of appraisal. Fixture, personal property that has been attached to the real estate in a way that removing the personal property would damage the real estate. It is required to use the real property, or if the intent of the owner was to make the personal property part of the real estate, the personal property is now part of the real estate. Floor plan agreement, when a retailer finances the purchase of merchandise inventory with a financial institution or the supplier of the inventory. Gross margin method, inventory accounting method to adjust fiscal year to calendar year or adjust books due to company merger. Intangible personal property that cannot be subjected to the census. Level of trade, merchandise items may be divided into these classes: primary producer, manufacturer, wholesaler, distributor, retailer. LIFO, last in, first out, an accounting method that removes the cost of the most recently acquired goods from the accounting records first, leaving the inventory with the oldest acquisition date on the books. This method is the least accurate method of acquisition cost because prices tend to rise and those historical items usually have a lower acquisition cost. Companies that use the LIFO should have a LIFO reserve to report in addition to the inventory cost. Market value of inventory, defined by the Texas Property Tax Code as the price for which inventory would sell as a unit to a buyer who would continue the business. Merchandise and use items, the major classification of tangible personal property. Merchandise inventory, goods held for the purpose of sale. Mobilia rule, property is taxable if the domicile of the owner, domicile situs, if it does not acquire an actual situs, acquired situs, of its own by being more or less permanently located at one place. Personal inspection method, see density method. Personal property, all property that is not real property. Retail markup, finding the retail percent markup and then using it to reduce the retail prices back to cost for the year-end inventory rule. Salvage value, when a use item is no longer used but someone will buy it in its current condition, fix it up, or put it to use. Scrap value, when a use item is no longer used and can be sold for only the value of the parts that make it up. Situs, taxable situs means jurisdiction or location to tax the subject property. Square foot method, see the density method. Tangible personal property that can be subjected to the census. Use items, goods that have reached the use for which they were originally intended. Value in use, the contributory value when a use item is still useful even though its remaining economic life or its book value is 0. Weighted average or average cost method, the total cost of the inventory including all purchases made during the year is divided by the total number of items in the inventory throughout the year to get an average cost per item. This average cost per item is then multiplied by the number of items in the inventory at the year's end to get a cost estimate for the year-end inventory. Discovery of personal property, the process. Locate, taxability, jurisdiction, or situs. Personal property discovery, locate tools, previous year's appraisal roll, personal property renditions, local publications such as newspaper and magazines, state comptroller's office, the sales tax data, telephone and city directories, county clerk's DBA and assumed name records, government agencies and utilities, field inspections. Tangible personal property is taxable by jurisdiction if it is located in the jurisdiction on January 1 for more than a temporary period, that is acquired situs. It is normally located in this jurisdiction even though it may be temporarily outside of the jurisdiction on 1/1, again acquired situs. It is normally returned to the jurisdiction between uses elsewhere, and it is not located in any one place for more than a temporary period, also acquired situs. The owner resides or maintains his principal place of business in the jurisdiction, and the property is in this state, but does not have a taxable situs according to 1.3 above, domicile situs. Fixture, rule, or guideline. If the item is movable, it's personal property. If the item may be moved without damage to the real estate, it's personal property. If the intent of the owner is that the item is subject to being moved, it is personal property. If the item is permanently affixed to the real property, it's real property. If the item may not be moved without damage to the real estate, it's real property. And if the intent of the owner is that the item be used permanently as it is attached to the real estate, it is real property. Total absolute exemption. This is how you get it, maybe, or these are total absolute exemptions. Okay, so U.S. government property, goods in transit, interstate, goods stocked for business advantage are taxable. Foreign government property by the U.S. treaty, state and local government property, religious organizations, schools, public or private, trifold youth organizations, non-profit organizations, institutions of purely public charity, farm products in the hands of the producer, implements of husbandry, intangible personal property except some insurance companies, railroads, toll roads, ferries, and oil pipelines, private vehicles and recreational boats not used for the production of income, household goods and personal effects not used to produce income, solar and wind-powered energy devices, pollution control equipment, foreign trade zone, and freeport goods. Partial exemptions. Part of the value of the property is part of the value of a property a disabled veteran owns. The amount is based on the percentage of disability.
You sound like you're reading like you have a disability.
No joke. Current replacement cost. The current cost to replace the inventory on hand as of the date of appraisal. Example, pump spindles cost $10 each and cost $1 to ship plus 50 cents for extra package cost. The manufacturer offers a discount of 5% for swimming pool companies that purchase more than 12 per shipment. Your company needs to purchase 24 to stock up for the summer season. What will be the cost of your inventory? So, let's see, 24 spindles at $10 each is $240. You get a discount of 5%, so 24 times 5.05, or is it the $10 times 0.05 for the $12 less $12 extension there?
240. 5% of 240.
Oh, so it's 5% of the 240. Okay.
Yeah.
So then your subtotal becomes $228. There's shipping. 24 spindles times $1 each is $24. There's 50 cents of the packaging. So 50 cents times the 24 is another $12. So your total is $264 for the cost of the inventory. Note. It's a note. Discounts affect the cost per unit, not shipping and handling cost. Total of cost of inventory is equal to acquisition cost plus freight and handling minus the discounts and returns. That's the end of the note. And right there it says pay attention to the notes. So, density methods. Use of tables or schedules that show typical property value per unit of measure for types of property with certain characteristics, known as the square foot method, the personal inspection method, or the comparison method. Value in a schedule is equal to replacement cost new, or RCN. A specific method for using area measurement and a density cost factor to estimate the market value of inventory. Density method in appraising inventory. Whoa, sorry, I went several pages. I went like that, and it went. So I got to go back to my spot. So what page am I on?
18.
Oh yeah, I was on 23. Okay, back to density methods. Use of tables or schedules that show typical property value per unit of measure for types of property with certain characteristics, known as the square foot method, the personal inspection method, or the comparison method. Value in a schedule is equal to replacement cost new, or RCN. The specific method for using area measurement and a density cost factor to estimate the market value of inventory. Density method in appraising inventory. Appraisers follow a 5-step process to arrive at market value of a subject inventory using a density schedule. Number 1, classify the subject property on the basis of business type, beauty salon, supermarket, etc., and the level of trade of the business. Number 2, measure the space in which the company maintains the inventory. Note the density and quality, any special features of the property, such as location in a mall, and inventory not typical of business of that type. Number 3, select the inventory schedule value from the category that best describes the property. Number 4, adjust the schedule value to reflect any special features of the subject property. Number 5, multiply the value from step 4 by the unit of measure from step 2 to estimate the market value of the subject inventory. Here's an example. The subject is a medium-sized meat packing plant with an average mix of inventory. The inventory is considered average quality with average density. So you're going to take the square footage. Well, number 1, you got to classify the subject property. It's a meat packing plant. I guess I need to read the... Okay, we're going to read this whole Curry's meat packing inventory list.
Just read it. It's average. Average and average.
Just read those 2 columns and rows?
Kind of describe what you're going to do. You're going to join it. You're going to pick the average plant.
Okay, so we're going to pick the average quality plant, and we're going to pick the average density sample property and meet those in the middle. So it's a medium plant of average mix of inventory. So it's a 14.82. Does that mean anything? Or is that just up to this chart?
Probably to that chart.
Okay, so appraising inventory using a density schedule are as follows. Classify the business as a meat packing plant. I already said that. Note that the store is a medium-sized meat packing plant with an inventory of average quality and density. Measure the area of the plant. So 50 foot by 130 foot is equal to 6,500 square feet. Find the schedule factor for average density, average quality. It is $14.82 per square foot. Adjust the schedule factor as required. No adjustment is required. So multiply the adjusted factor times the area to estimate the market value. So 1482 times 6,500 square feet is equal to 96,330. Note. Inventory can lose value to any one or all three of the forms of depreciation. Depreciation is not typical for inventory, but one may find loss particularly in the food or technology business. End note. Appraisal of inventory using accounting records. Hey, you're welcome. I mean, does it help? Okay, good. Weighted average or average cost method. The total cost of the inventory, including all purchases made during the year, is divided by the total number of items in the inventory throughout the year to get an average cost per item. This average cost per item is then multiplied by the number of items in the inventory at the year's end to get a cost estimate for the year-end inventory. This method is only accurate when inventory is very similar in cost and type. A 99-cent store is a good example. The example is total annual purchase amount 528,000. Total number of units purchased 1,200,000. So then 528,000 divided by 1,200,000 is equal to 44 cents per unit. Number of units on hand 4,546. So 4,546 units times 44 cents per unit equals $2,000.24. LIFO, last in, first out, which is an accounting method that removes the cost of the most recently acquired goods from the accounting records first, leaving the inventory with the oldest acquisition date on the books. This method is the least dependable method of acquisition cost because prices tend to rise and those historical items usually have a lower acquisition cost. Companies that use LIFO should have a LIFO reserve to report in addition to the inventory cost. FIFO, first in, first out inventory accounting system. The inventory items with the oldest historical cost are removed from the company books first. This is a more accurate method of cost accounting as it will more closely reflect the cost of inventory as of the date of appraisal. Retail markup method or retail method. Finding the retail percent markup and then using it to reduce the retail prices back to cost for the year-end inventory value. Retailers generally use the cost of an item to increase the price or mark it up by a percentage to calculate the retail price. The retailer has used the actual cost for the base of the market up and multiplied. That didn't make sense. To get back to the cost, we must use the opposite mathematical operation or divide. You said O. Do you understand?
Yeah.
Okay. Example, retail value, January 1, is equal to $245,875 with a 35% markup. Markup factor is equal to 1 plus 0.35 or $1.35. So $245,875 divided by $1.35 or 1.35 is equal to $182,130 for cost, that's what you wrote. Now check the math. If the calculated cost is $182,130 and we know the markup is 35%, do we get back to the reported retail value of $245,875? I guess you know how to check that math there. Okay. Gross margin method or gross profit method. Inventory accounting method to adjust fiscal inventory to calendar year or to adjust to company books when a merger occurs. This method uses the most recent physical inventory records and then makes adjustments based on inventory added, sales that have occurred, and the cost of sales ratio. The cost of sales ratio or profit can be calculated by dividing the cost of goods sold, the COGS, in the previous period by sales in the previous period, calculated below. Now we reduce the retail value of the sales for this period to cost by multiplying the cost of sales ratio to get all of our inventory information to cost. So gross margin method example. Get down off the piano, you big goober, get in. Sorry. Gross margin method example. Cost of goods sold in the previous period, $584,275. The sales in the previous period is equal to $798,123. So the cost of sales ratio is 0.73 to 1. The sales for the current period at retail is $216,817. The beginning inventory at cost was $467,258. Purchases this period at cost were $97,432. Calculate the following. Sales at retail is $216,817 times 0.073 to 1 is equal to $158,732 removed from inventory. Beginning inventory at cost, $467,258. Purchases this period at cost, $97,432. Total value of inventory at cost, $405,958. So my question is, that minus that's in front of the $158,732, is that a negative or is that
it's a negative.
It's not a dash?
No.
Okay. Appraisal of use items, F&F, M&E, and other non-realty items. Cost approach. Replacement cost new less depreciation, the RC&LD. Sources of RC&LD include cost schedules or cost guides, historical cost indexing, observed condition method. Observed condition method example. The replacement cost of a forklift is $62,840. The forklift is estimated to be 12% depreciated based on its effective age and economic life. 100% minus percent depreciation equals percent good. 100% minus 12% equals 88% good. 62,840 times 0.88 equals 55,299 RC&LD, or replacement cost new less depreciation. Density schedules, use items. Examine the rendition and or inspect the property to classify it. Estimate effective age, quality, and density. Measure the area, usually square footage, where the property is located. Find the unit cost on a schedule for that type of property with similar density and quality characteristics, similar to inventory valuation. Find percent good remaining using typical economic life from the density schedule and your estimate of effective age. Adjust the schedule value for percent good remaining. Multiply the adjusted schedule value times the square footage to estimate market value. Example, you are appraising a 10-year-old convenience store with average quality and high density furnishings and equipment. The FF&E is an area that has 1,000 square feet. What is the estimate of market value? Note actual age equals effective age. So go to the density schedule for a convenience store, FF&E. What is FF&E?
Fixtures, furnitures, and equipment.
Oh, okay. So it's got high density and it's got average quality, so that's 11.00. So life in years is equal to 12. Depreciation guide percent good. So the effective age is 10, and then you go over to 12 because it's got the typical life expectancy, and so that number is 0.36. So your solution is 1,000 square feet times the $11 square foot equals $11,000 of RCN, and 11,000 of RCN times 0.36, which is percent good, is equal to 3,960 for RCN-LD, or replacement cost new less depreciation. Price guides in appraising use items, national or built locally. Examine the rendition and inspect subject property in order to classify it. Be alert to special features and reconditioning that will add to the value. Estimate effective age, condition, and degree of use aspects that will decrease value. Find the price of typical personal property of that type in a price guide. Calculate adjustments and modify the price according to the directions the guide provides. Estimate the market value of the item using the adjusted price and any additional information that affects the value. Cost indexing. Replacement cost is equal to acquisition or historical cost times the index multiplier. RC and LD is equal to historical cost times index multiplier times percent good. This is the same process as indexing used. That doesn't make sense. This is the same process as indexing used in real property. Cost approach, trended historical cost. That doesn't make sense.
Makes sense to me.
Well, how can you process indexing used?
This is the same process as indexing used in real property. Cost approach, trended historical cost.
Okay, so I'm reading it wrong.
Well, you just probably don't know how to read it.
I'm reading it wrong.
Well, you are, but I mean, you don't know how to read it.
Okay, but I get it whenever you read it, that this is the same process as indexing. It should say which is used in real property cost approach, trended historical cost.
Okay.
Oh, words matter. A Caterpillar excavator cost $45,000 in 1997. What is the trended historical cost less depreciation, or RCN-LD? The 2018 index is 1886.5. The 1997 index is 1228.3. Physical age is 11 years, so it's 37% good. Effective age is 8 years, which is 55% good. So the calculation is current year index divided by historical year index times cost times percent good. So 1886.5 divided by 1228.3, and you figure out that, multiply that times 45,000, multiply that times 0.55, and it equals 38,013. By examining the indices, we can see that the cost of the equipment has increased as the current index is larger than the historical index. This will be true in most situations due to inflation. Practice problems. Primary producer.
No.
Oh, level of trade, cost of inventory. Primary producer, raw materials. Manufacturer, raw materials. Manufacturer, goods in process. Manufacturer, finished goods. Wholesale, distributor, merchandise. Retailer, goods for sale. Consumer, use items. Profit will be added at each level to arrive at total cost of inventory. Level of trade, primary producer, raw materials, and then total cost.
Plus profit. And then.
What?
Just read it.
Okay. I was going to. So, primary producer. Okay, let me ask you this. Is raw materials have anything to do with primary producer, or is that the plus profit?
Yes. Primary producer is raw materials. A primary producer has raw materials.
Right.
But you're adding profit on each level of trade as you're going.
Right. So for your primary producer and the raw materials, you're going to take the total cost of inventory plus profit. Mm-hmm. For the manufacturer, the raw materials, goods in process, and finished goods, you're going to take the total cost of inventory and add profit. For the wholesale distributor, you're going to take total cost of inventory. The wholesale distributor, they're going to have merchandise, and so you're going to take the total cost of inventory and add profit. And then for the retailer, you're going to take goods, the retailer, which is goods for sale, you're going to have the total cost of inventory plus profit. The consumer, there are use items, you're going to take the total cost of the use item. Did I read that right?
Yes.
Phew. Discovery of personal property, locate, determine taxability, jurisdiction, situs, personal property discovery tools, previous year's appraisal. Did you have me on the wrong stuff?
Yeah.
So disregard everything that I said.
No, don't disregard it. Just repeat it. So read on this.
Oh boy. A manufacturer purchased equipment in 2008 for $9,345. The cost index for 2008 is 629. The cost index for 2018 is 846. What happened to the cost of equipment like this between 2008 and 2018? The answer is the cost of equipment like this increased. 846 divided by 628 equals 1.345. Number 2, use the table following this question to determine the percent of normal depreciation for a machine with an effective age of 5 years and a 15-year economic life. The answer is C, 27%. Number 3, which property item is not an example of real property? C, a communication tower. Number 4, which of the following property items is not exempt from property taxation? The answer is A, office space rented to the school district. Number 5, which of the following does a Texas taxing unit have jurisdiction to tax? The answer is D, property in Austin, Texas, owned by a resident of Canada. I need to answer to my son. Can we pause? Hello?
We just finished up at Hannah's house.
When you're ready to go.
Okay, the figure below shows part of a density table for carpet inventory. What is the value of 1 cubic foot of high density average quality inventory? The answer is D, $21. Which is the best definition of depreciation? B, the decrease in market value that arises from a property's loss of usefulness. Number 8, what is the best definition for effective age of an item of property? A, the effective age measures the age of property in terms of condition and usefulness. Number 9, a computer is 32% good. Which arithmetic operation do you use to determine the current value of the computer? A, 0.32 times the replacement cost. Number 10, an automobile with a replacement cost of $32,459 has depreciated 13%. How much value has the automobile lost? The answer is D, $4,220. To arrive at that, you take the $32,459, multiply that by 0.13 is equal to $4,220. Number 11, a business uses the average cost method to estimate its cost of inventory. On December 31st, this company had 3,782 items on hand. The following information was obtained from its purchase journal. Average cost per unit is equal to total dollars spent divided by total units purchased. 84,874 divided by 53,000 equals 1.6014 average cost each unit. Cost of inventory using average cost method. Units remaining in inventory. 3,782 times 1.6014 equals $6,056.48. Carry the average cost of one item to 4 decimal places. Number 12, the ladies ready-to-wear in your jurisdiction uses the retail method for determining inventory valuation. On December 31st, an inventory count was taken out of the store and the following facts were determined. Retail value of clothing, $225,000 divided by 1.40 equals $160,714. Retail value of accessories, $90,000 divided by 1.50 equals $60,000. An audit of the books and records of the company reveals the following information. Beginning inventory at cost, $486,210. Purchases at cost, $81,990. Sales at cost, less $226,286. Ending inventory at cost, $341,914. Sales at retail, $316,800 divided by 1.40 equals $226,826. Surely there's something in the problem.
Yeah, I think so, yeah.
Let's hope so.
Okay.
Number 14, a wholesaler of flip phones renders the following financial information. What is the owner's opinion of value? The data, the retail, the cost of goods sold ratio, and then the cost are the column headings. So the data, inventory at cost, it has a cost of $450,000. The purchases at cost is $101,110. So the sales at retail were $482,075. Cost of goods sold ratio is 0.9222. So that's less $445,192 for a total of $105,918 multiplied by the oversupply factor of negative 15%, but you multiply 100 minus the 15, which is 85. So 105,918 times 85% is equal to $90,030, which is the owner's opinion. I hope I read that right. So appraise the shoe store's tangible business personal property. Square footage is 50 times 125 equals 6,250 square feet. FFE, 6,250 square feet times 4.00 times 0.58 equals 14,500. Inventory is 6,250 square feet times $20 per square foot, which is 125,000. So 125 plus 14,500 equals a total BPP value of 139,500.